I've been buying energy stocks aggressively over the past 3 years, and almost nobody noticed. While the financial media was obsessed with technology stocks, artificial intelligence, and electric vehicles, while most institutional investors were divesting from fossil fuels under ESG pressure, while the conventional wisdom said energy was a dying industry, I was doing the opposite. I was building massive positions in oil and gas companies, accumulating stakes worth tens of billions of dollars. And I wasn't just buying any energy stocks. I was selecting specific companies with characteristics that give them extraordinary advantages in what I believe will be a very profitable decade for energy investors. Today, I'm going to tell you exactly which 7 energy stocks I've been buying, why I chose each one, and why I believe energy represents one of the best investment opportunities available right now. Because while everyone else is looking the other way, a massive wealth creation opportunity is developing in the most unloved sector in the market. Let me start by explaining why I'm so bullish on energy, because if you don't understand the fundamental thesis, you won't have the conviction to hold through volatility. The prevailing narrative says fossil fuel demand is dying, that electric vehicles will destroy oil consumption, that renewable energy is taking over, that investing in oil and gas is betting against the future. This narrative has become so dominant that most investors treat it as fact. But the data tells a completely different story. Global oil demand is not declining, it's growing. We consumed about 100 million barrels per day before COVID. We're back above that level now, and the International Energy Agency projects continued growth through at least 2030. Yes, electric vehicles are growing rapidly, but they're still less than 5% of global car sales. The existing fleet of over 1 billion internal combustion vehicles will take decades to replace. And electric vehicles don't touch aviation, which consumes 6 million barrels per day. They don't touch shipping, which consumes 4 million barrels per day. They don't touch petrochemicals, which uses 10 million barrels per day to make plastics, fertilizers, and chemicals. The idea that oil demand will collapse quickly is simply not supported by reality. Meanwhile, supply is being constrained. The oil industry underinvested dramatically from 2015 to 2020 after oil prices crashed. Major oil companies cut exploration budgets by 50 to 70%. It takes 5 to 10 years to bring new oil projects online. The underinvestment from years ago means we're now facing a supply crunch.
U.S. shale growth has slowed. OPEC has limited spare capacity. There are very few large-scale new projects coming online. The setup is demand still growing while supply growth is constrained.
That's a recipe for higher oil prices. But here's what makes this opportunity even better. Energy companies learn from the boom-bust cycles of the past. They're not ramping up production aggressively when prices rise. They're maintaining capital discipline, keeping production relatively flat or growing slowly, and returning massive amounts of cash to shareholders. The economics are extraordinary. Many major energy companies are generating free cash flow yields of 10 to 15%. They're paying dividends of 4 to 6% and buying back shares aggressively. If oil stays in the $70 to $90 range, which I think is likely, these companies are going to generate returns that will shock investors who have ignored the sector. So with that thesis in mind, let me tell you about the 7 energy stocks I've been buying and why each one made my list. The first is Occidental Petroleum, and this is actually my largest energy position by far. Berkshire has accumulated over 250 million shares of Occidental, making us the largest shareholder with over 25% of the company. We've been buying steadily since early 2022, and I've recently gotten regulatory approval to potentially acquire up to 50% of the company. Why am I so bullish on Occidental? First, Occidental has world-class assets in the Permian Basin, the most productive oil field in North America. Their Permian production is extremely low cost, with break-even prices in the $30 to $40 per barrel range. Even if oil falls to $60, they're making huge margins. This gives them downside protection and strong profitability across a wide range of oil prices. Second, Occidental is paying down debt aggressively. They took on significant debt when they acquired Anadarko Petroleum in 2019. That acquisition was poorly timed right before COVID and oil prices crashed. But rather than falling into bankruptcy like some feared, Occidental has been reducing debt by billions of dollars per year. As debt falls, the equity becomes more valuable. Third, Occidental is returning cash to shareholders. They pay a dividend currently yielding around 2%, and they've increased it several times. They're also buying back shares, and here's the key. They have preferred shares that Berkshire owns that pay us 8% annually. We earn billions in dividends from Occidental every year. Fourth, Occidental is investing in carbon capture technology. They're building facilities that capture CO2 from the atmosphere and inject it underground. This could become a significant business as regulations around carbon emissions tighten. They're positioning for an energy transition while still making money from oil and gas. The CEO, Vicki Hollub, is excellent. She's a geologist by training, understands the assets intimately, and has navigated the company through a very difficult period. I have confidence in her ability to create shareholder value. Occidental at current prices around $60 per share offers substantial upside if oil prices stay strong. My cost basis is in the $50 to $60 range, and I think the stock could reach $80 to $100 over the next few years. The second stock is Chevron, one of the most boring stocks in my portfolio, and that's a compliment. Chevron is a high-quality integrated major with upstream oil and gas production, downstream refining and chemicals, and operations around the world. They have one of the strongest balance sheets in the industry, with manageable debt and strong cash generation. Chevron pays a dividend currently around 3.5% and has increased it for 36 consecutive years. They're a dividend aristocrat. This is the kind of company you can own forever. What I particularly like about Chevron is their capital allocation discipline. They're not chasing production growth. They're focused on returns. They maintain their production base, invest in high-return projects, and return excess cash to shareholders through dividends and buybacks. Management has stated they want to return 50% or more of cash flow to shareholders. At current oil prices, they're generating around $35 billion annually in free cash flow. That's enormous return potential. Chevron also has significant exposure to liquefied natural gas. They have major LNG projects in Australia, and they're developing new projects in the United States. As global natural gas demand grows, especially in Asia, where countries are shifting from coal to gas for power generation, Chevron's LNG assets become more valuable. Natural gas is likely to be a growth business for decades as it serves as a bridge fuel in the energy transition. Berkshire owns about 130 million shares of Chevron, worth roughly $20 billion. It's our fifth or sixth largest holding. The position has grown both from purchases from stock appreciation. I view Chevron as a core holding that we'll likely own for many years. It's not going to triple overnight, but it will steadily generate cash, pay dividends, buy back shares, and compound value over time. The third stock is ConocoPhillips, and this is the purest upstream play in my portfolio. Unlike Chevron, which has refining and chemicals, ConocoPhillips is purely exploration and production. They find oil and gas, produce it, and sell it. This means they benefit most directly when oil and gas prices rise. But it also means they're more exposed to commodity price volatility. I'm comfortable with that volatility because I believe we're in a rising price environment. ConocoPhillips has a diversified asset base across multiple basins in North America, including the Permian, Eagle Ford, and Bakken. They also have production in Alaska, Norway, and several other countries. This diversification reduces risk. They're not dependent on any single field or geography. The company generates massive free cash flow, around $15 billion annually at current prices. They've committed to returning over 50% of cash flow to shareholders through a combination of ordinary dividends, variable dividends tied to commodity prices, and share buybacks. What I particularly appreciate about ConocoPhillips is their variable dividend structure. When oil prices are high and cash flow surges, they pay special variable dividends on top of the ordinary dividend. This allows shareholders to participate directly in commodity price upside. When prices are lower, the variable dividend falls, but the company remains profitable and the ordinary dividend is maintained. It's an intelligent way to balance returning cash with maintaining financial flexibility. ConocoPhillips trades at a very reasonable valuation, around 8 to 9 times earnings. For a company generating this much free cash flow with quality assets, that's cheap. The market is essentially saying it doesn't believe commodity prices will stay elevated. I disagree. I think we're entering a period of structurally higher energy prices, and ConocoPhillips will be a major beneficiary. The fourth stock is EOG Resources, another pure play upstream producer, but with a different profile than ConocoPhillips. EOG is focused primarily on U.S. shale production, with most of their assets in Texas and New Mexico. What makes EOG special is their low-cost structure and their technology. They've been pioneers in developing more efficient drilling and completion techniques that reduce cost per barrel. Their average break-even prices are among the lowest in the shale industry. EOG doesn't try to maximize production growth. They focus on profitable growth and capital efficiency. They'll only develop wells that meet high return thresholds. This discipline means they generate strong free cash flow even at moderate oil prices. They've been returning around 70% of free cash flow to shareholders through dividends and buybacks. The ordinary dividend yields around 3%, and they pay special dividends when cash flow is strong. What gives me confidence in EOG is their track record of execution. They've consistently delivered on their production targets, kept costs down, and generated returns through multiple commodity price cycles. Management owns significant stocks, so their interests are aligned with shareholders. This is a well-run company with good assets and shareholder-friendly capital allocation. The fifth stock is a bit different. Enterprise Products Partners. This is not an oil producer. It's a midstream company, meaning they own pipelines, storage facilities, processing plants, and export terminals. They're the infrastructure that moves oil, gas, and natural gas liquids from production sites to refineries, chemical plants, and export facilities. The business model is fundamentally different from producers. Enterprise doesn't take commodity price risk. They charge fees to transport and store energy products under long-term contracts. Whether oil is $50 or $100 per barrel, Enterprise gets paid their fee. This creates very stable, predictable cash flows. The company pays out most of its cash flow as distributions to unit holders. The current distribution yield is around 7%, and they've increased distributions for 25 consecutive years. It's like a utility for energy infrastructure. Why do I own midstream instead of just producers? Diversification and income. The high distribution yield provides current income, and the stability of the business model reduces portfolio volatility. Enterprise also has growth opportunities as new production in the Permian and other basins requires additional pipeline capacity. They're building new pipelines, expanding existing ones, and developing export facilities. These projects generate attractive returns and support distribution growth. Enterprise Products Partners is structured as a master limited partnership, which has tax advantages but also complexity. The distributions are treated differently than ordinary dividends for tax purposes. You need to be comfortable with K-1 tax forms if you own MLPs, but the distribution, yield, and growth profile make the complexity worthwhile in my view. The sixth stock is Diamondback Energy, a smaller but very high-quality Permian pure play. Diamondback focuses exclusively on the Permian Basin, primarily in the Midland Basin area of West Texas. They have some of the best acreage in the entire play. What I like about Diamondback is their commitment to returning cash to shareholders. They've stated that their goal is to return 75% of free cash flow to shareholders, one of the highest payout ratios in the industry. They use a variable dividend structure similar to ConocoPhillips. The base dividend is conservative and highly sustainable. Then they pay variable dividends on top based on free cash flow generation. In strong commodity price environments, shareholders get massive total dividends. The total dividend yield has been running 6 to 8%, which is extraordinary for an equity investment with growth potential. Diamondback is also a potential acquisition target. As the industry consolidates, larger companies like Chevron or Occidental might want to acquire Diamondback for its high-quality Permian acreage. That provides additional upside optionality. Even if they remain independent, the combination of strong assets, low costs, and high shareholder distributions makes this an attractive investment. The seventh and final stock is a recent addition, Occidental Petroleum Preferred Shares. Wait, you're saying you already mentioned Occidental as your first stock. Yes, but the preferred shares are a different security with different characteristics. When Occidental acquired Anadarko and they needed financing, Berkshire provided $10 billion by purchasing preferred shares that pay us an 8% annual dividend. We receive $800 million per year in dividends from these preferred shares. The preferred shares also came with warrants, allowing us to buy 83 million shares of Occidental common stock at about $63 per share. We've exercised some of these warrants as Occidental's stock price rose above the strike price. This structure gave us downside protection through the fixed 8% dividend on the preferred shares, plus upside participation through the warrants on the common shares. It's an ideal investment structure. Why am I mentioning the preferred shares separately? Because preferred shares of quality energy companies are an underappreciated investment. They pay higher yields than common shares, have priority in capital structure over common stock, and provide more downside protection. They don't have the same upside potential as common shares, but for investors seeking income with less volatility, energy company preferred shares are worth considering. Several major energy companies have preferred shares outstanding that yield 5 to 7% with investment-grade credit quality. Now let me tie this together and explain why you should consider following my lead into energy stocks. First, the fundamental supply-demand setup is excellent. Demand is growing modestly, supply growth is constrained, and that creates a bullish price environment. Second, energy companies are returning cash to shareholders at unprecedented levels. The free cash flow yields are extraordinary compared to other sectors. Third, valuations are cheap. Energy stocks trade at single-digit price-to-earnings multiples, while the broader market trades at 20-plus times earnings. The market is giving you a huge discount to own energy. Fourth, energy provides inflation protection. When inflation rises, energy prices typically rise, and energy company earnings increase. If you're worried about inflation, energy stocks are a hedge. Fifth, energy is unloved and underowned. Most institutional investors have reduced energy exposure. This creates opportunity. When sentiment eventually shifts and investors recognize the value in energy, there will be significant buying pressure and limited supply of shares. That's a recipe for strong price appreciation. Let me address the common objections to investing in energy because I hear them constantly. First objection: climate change means we should divest from fossil fuels. My response: I care about climate change. I pledge to give away 99% of my wealth, and much of it will go to addressing important problems, including climate and environmental issues. But as an investor, my job is to allocate capital to generate returns for Berkshire shareholders. And the reality is that fossil fuels will be necessary for decades during the energy transition. Divesting doesn't reduce emissions. It just transfers ownership of oil and gas assets from public companies with environmental standards to private companies or state-owned enterprises with fewer standards. Second objection: electric vehicles will destroy oil demand. My response: EVs will take decades to replace the global vehicle fleet, and EVs don't address aviation, shipping, or petrochemicals. Total oil demand will eventually decline, but not for many years, and probably not below 80 to 90 million barrels per day, even in optimistic EV adoption scenarios. That's still massive demand supporting strong prices. Third objection: renewable energy is cheaper than fossil fuels. My response: renewable energy is cheaper on a marginal basis for electricity generation in some locations, but electricity is only 20% of total energy consumption. Transportation fuels, industrial heat, and petrochemicals can't easily switch to renewables. And even for electricity, renewables require massive backup capacity from natural gas because the sun doesn't always shine and the wind doesn't always blow. Fossil fuels will remain essential for decades. Fourth objection: energy stocks are too volatile. My response: volatility creates opportunity. Yes, energy stocks fluctuate with commodity prices, but if you buy quality companies at reasonable valuations and hold long-term, you'll do well. The high dividends provide downside cushion and income during weak price periods, and the upside during strong price periods is substantial. Over full cycles, energy stocks have generated excellent returns. Let me give you practical guidance on how to implement an energy investment strategy. First, decide how much of your portfolio to allocate to energy. I've got about 15 to 20% of Berkshire's equity portfolio in energy currently. For individual investors, I'd suggest at least 10% if you believe in the thesis. That's enough to matter if energy performs well, but not so much that it dominates your portfolio. Second, diversify across different types of energy companies. Own at least one integrated major like Chevron for stability. Own at least one pure upstream producer like ConocoPhillips or EOG for commodity price leverage. Consider midstream infrastructure like Enterprise Products Partners for income. This diversification reduces single company risk while maintaining sector exposure. Third, buy gradually rather than all at once. Energy stocks can be volatile. Rather than investing your full allocation immediately, spread purchases over several months or quarters. This dollar cost averaging reduces the risk of buying at peak prices. If you buy over time, you'll capture average prices and might get some shares at temporarily depressed levels. Fourth, focus on free cash flow and shareholder returns rather than production growth. The best energy investments today are companies that prioritize returning cash over growing production. Look for high free cash flow yields, strong dividend yields, and active share buyback programs. These companies will compound value steadily regardless of commodity price fluctuations. Fifth, be patient. Energy has been unloved for years. It might take time for the market to recognize the value. Don't expect immediate gratification. But if you buy quality companies at reasonable prices and give the thesis time to play out, I believe you'll be rewarded handsomely. My time horizon for these investments is at least 3 to 5 years, probably longer for core holdings like Chevron. Let me address position sizing for each of the 7 stocks. If you're allocating 10% of your portfolio to energy and want to follow my 7-stock approach, here's how I'd weight them. Chevron, 30% of your energy allocation for stability and quality. Occidental, 25% as a higher conviction bet on Permian production and debt reduction. ConocoPhillips, 20% for pure upstream exposure. EOG Resources, 15% for shale exposure. Enterprise Products Partners, 10% for midstream income. Diamondback Energy, 5% as a smaller high conviction position. And Occidental preferred shares, if you can access them, 5% for enhanced income. This weighting emphasizes the larger, more stable companies while including smaller positions in higher growth or more specialized names. You can adjust based on your own risk tolerance and conviction levels. If you want more stability, increase Chevron and Enterprise Products Partners. If you want more upside, increase Occidental and Diamondback. The important thing is having diversification across the energy value chain while maintaining concentrated positions in your highest conviction ideas. One final point about timing. People always ask, is now the right time to buy energy stocks? What if oil prices fall? What if there's a recession? My answer is that I don't try to time purchases based on short-term commodity price predictions. I can't predict where oil will be in 6 months. Nobody can. What I can analyze is the long-term supply-demand fundamentals, the quality of companies, the capital allocation strategies, and the valuations. All of those factors look attractive to me right now. If oil falls to $60 and energy stocks decline, that would actually be an opportunity to buy more, not a reason to panic. The companies I've selected can generate strong returns even at $60 oil. They'll survive and thrive through volatility. If oil goes to $100 and energy stocks surge, you'll wish you'd bought more at today's prices. The point is, at current valuations with current fundamentals, I believe energy stocks offer compelling risk-reward over a multi-year horizon. Trying to time the perfect entry point is likely to result in missing the opportunity entirely. I started buying energy stocks aggressively in early 2022 when oil was in the 80s. And everyone said it would crash back to 40. Oil went to 120, then settled in the 70 to 90 range. I kept buying. Energy stocks roughly doubled from those levels. I'm still buying because I believe we're still early in this cycle. The fundamentals remain excellent, valuations remain reasonable, and the cash distributions to shareholders are extraordinary. The 7 stocks I've outlined, Occidental Common, Chevron, ConocoPhillips, EOG Resources, Enterprise Products Partners, Diamondback Energy, and Occidental Preferred, represent my highest conviction ideas in the energy sector. Each offers different risk-return characteristics. Together, they provide diversified exposure to what I believe will be one of the best performing sectors over the next several years. While everyone else is chasing artificial intelligence and technology stocks at extreme valuations, I'm quietly accumulating energy stocks that generate massive cash flows and trade at single-digit earnings multiples. History suggests that buying what's unloved and selling what's beloved is the path to superior long-term returns. That's exactly what I'm doing. And if you understand the thesis, if you're willing to go against conventional wisdom, if you can be patient and ignore short-term volatility, I believe you should do the same. The opportunity won't last forever.